In the previous video, we've covered the circular flow of income two-sector model, but of course, the real economy is much more complicated. Households do not spend all of their income on domestically produced goods and services. Instead, some income leaves the circular flow, while additional spending can also enter it. To represent this, we add three more sectors: the government, the overseas sector, and the financial sector. And this gives us the five-sector circular flow of income model. Let's begin with all the leakages. Leakages are withdrawals of spending from the circular flow, and there are three leakages: taxes, savings, and imports. Well, the first is taxation. Households pay part of their income to the government in the form of taxes. And the second is imports. Households may also spend part of their income on goods and services produced overseas rather than by domestic firms. And finally, there's savings. Instead of spending all of their income, households save some of it in domestic financial institutions. Since saving, taxes, and imports reduce spending on domestically produced goods and services, they are known as leakages. Fortunately, spending will also enter the circular flow in the form of injections. Again, there are three types of injections. The first is government spending, and the second is investment, and then finally we have export. Well, the government purchases goods and services from domestic goods, and this creates additional demand for their output. And then we have investment. Financial institutions use household savings to provide funding to firms. And firms invest in new machinery, buildings, plants, and technology, increasing spending within the domestic economy. And finally, we have exports. Foreign households and businesses purchase goods and services produced by domestic firms, and this brings additional spending into the economy from overseas. Together, government spending, investment, and exports are called injections because they add spending into the circular flow. But in the five-sector model, equilibrium occurs when total leakages equal total injections. In other words, if the sum of taxes, savings, and imports equal the sum of investments, government spending, and export. And then when this condition is satisfied, the total amount of spending in the economy remains stable. It doesn't have a tendency to increase or decrease. So the national income stays constant. So if the injection becomes larger than the leakages, more spending will enter the economy than leaves it. Firms receive more revenue, they will expand their production, and hence national income will rise. On the other hand, if leakages exceed injections, firms receive less revenue and production falls while national income will finally decline. In conclusion, the circular flow of income helps us understand how different sectors of the economy are connected.